The closing bell rang about 15 minutes ago on this Monday, March 9th, 2026, and here is the final scoreboard. S&P 500 squeaked out a microscopic 0.08% gain, closing right at the 6,808 level. Dow Jones Industrials managed a 0.15% bump, and the Nasdaq 100 actually slipped down 0.12%.
Right. And if you just glance at those headline numbers, you'd assume it was a total snooze fest, just completely sideways action. But the reality is this was a massive, low liquidity head fake.
Exactly. Because if you look at the internals, aggregate trading volume came in a full 14% below the 30-day moving average.
A literal ghost town.
Yeah, the institutional strategy briefs we're looking at tonight are explicitly calling it a ghost town on Wall Street. High-conviction players simply walked away from their desks today.
He stepped completely off the field. And the narrative here isn't that they're just taking a casual long weekend. They're paralyzed.
Because of what's coming Wednesday.
Exactly. You have two massive macro events hitting simultaneously on Wednesday, the February CPI print, which is obviously the inflation data everyone is terrified of, and the ECB policy meeting.
No portfolio manager in their right mind wants to be the first one through the door right now.
Right. You don't commit $1 billion of institutional capital into this market and then get caught offside by a surprise inflation spike. So volume drops off a cliff, and the tiny bit of price action we did see into the close today was just retail flow and algorithmic chop.
Which brings us to the internals, because the underlying metrics behind that tiny S&P gain are, frankly, atrocious.
The breadth was completely hollow.
Right. The advanced decline ratio was literally 1 to 2. For every single stock that went up, 2 went down.
But the real risk here is the psychological weight of that ratio when you look at the index levels. The S&P 500 notches a marginal all-time high, but the RSP, the equal weight S&P index, closed in the red.
That's a huge negative divergence.
Massive.
Because the standard S&P is market cap weighted.
Yeah.
So the mega cap tech companies are dragging the whole thing up, while the RSP treats the trillion-dollar giants exactly the same as the smallest company on the list.
It's the classic definition of a top-heavy market. In a healthy breakout, you get volume confirmation and broad participation. The rising tide lifts all boats. But today, the average stock actively retreated.
It's like watching your favorite basketball team win a game by 1 point.
Sure.
You see the final score, you're thrilled. But then you check the box score and realize only 2 of your star players scored any points at all. The other 3 guys on the court literally sat on the floor doing nothing.
And you mathematically cannot win a championship if the rest of the team refuses to play. That is exactly what the strategy desks are flagging. Capital is actively fleeing the mid-caps and small caps.
They're liquidating the broader economy to hide in the mega cap 6.
Exactly. It's a highly concentrated lifeboat trade. The market is basically cannibalizing its own smaller components just to keep the main S&P index flashing green on the screens.
And we also saw high-yield credit spreads widening throughout the session.
Which is the bond market calling the equity market's bluff.
Right, the bond market is demanding a higher premium to lend to riskier companies. They're pricing in fear while the stock guys are blindly buying the index.
The bond market is always the adult in the room. When credit spreads widen during an equity all-time high, you have to pay attention.
So let's track where the smart money is actually going. Because if they're abandoning the broader market, they're building an escape hatch. And we saw some brutal whiplash in the semiconductor space today.
Classic hollow rally action.
Look at NVDA and AMD. They opened the session with a huge 1.5% gap up, rode that early morning momentum, but by the closing print, they completely bled out and closed red.
A textbook shooting star reversal.
Yep.
Price shoots up, hits an absolute brick wall of institutional sellers, and collapses back to the daily lows. The AI premium is facing a serious reality check right now.
Traders saw that morning liquidity and used it to just take their profits and run. They trimmed the fat from their February gains.
But the real story is where that newly raised capital rotated.
To the most boring sectors imaginable, utilities and healthcare, XLU and XLV.
The ultimate defensive posture.
And the intraday chart on those is wild. Tech started high and crashed low. Utilities and healthcare did the exact opposite. Opened at the absolute lows, then caught this massive, violent wave of institutional buying to close at the highs.
A bullish outside reversal. They traded below Friday's lows, trapped the early retail bears, and then surged to close above Friday's highest price. That is institutional accumulation.
Which leads us directly to the market on close data. In the final 30 minutes of trading, the exchange registered a $1.9 billion sell-side imbalance at the MOC cross.
That is a staggering number for a low-volume day.
Almost $2 billion of excess sell orders leaning on the closing option. Real money was heavily dumping shares into the final bell.
Unloading their bags onto the retail traders who bought the midday tech rally.
Exactly. Retail thought we were breaking out and the big desks were just quietly raising cash.
Sure.
The strategy briefs literally say cash is a position.
And they're stepping out of the chaos because the macro layer today was absolutely terrifying. We have to talk about the oil whipsaw.
Oh man, the geopolitical whiplash in commodities today. Crude oil gapped all the way up to $120 a barrel on war fears.
A violent, conflict-driven spike.
Right, and if you're an active trader staring at $120 crude, you know the downstream inflation implications of that are catastrophic.
It destroys the entire rate cut narrative.
But then, almost instantly, the G7 announces a coordinated reserve release to deliberately flood the market. And crude violently craters back down to $94.
A V reversal from 120 to 94 in a single session. That is a brutal liquidity test for the global markets.
The equities market technically passed the test, right? Oil crashed, stocks recovered off the morning lows, and they priced out the geopolitical risk premium.
For now. But if you look at the VIX, the fear gauge, traders are still incredibly nervous.
The VIX was stubbornly sticky at 16.5 today.
Which shouldn't happen on a green day.
Right.
Usually if the S&P closes up, you get a volatility crash, the VIX drops.
But today it refused to go down.
Yeah.
The institutional briefs point out that market makers were flat out refusing to sell premium.
Nobody wanted to take on the risk of insuring against a crash right before Wednesday's data.
Instead, there was a massive spike in tail risk hedging. Aggressive put buying.
It's the equivalent of a billionaire rushing out to buy the most expensive hurricane insurance policy on a sunny 75-degree day.
Right, you're standing on the beach looking at this guy thinking he's crazy.
But he has access to a satellite feed showing a Category 5 storm just over the horizon. He doesn't trust the calm waters right in front of him.
Because he knows the CPI print could throw the whole thing up.
Exactly. The smart money used the intraday strength to buy expensive downside protection.
Which brings us to the look ahead for tomorrow. The strategy notes are actively laying out the tactical game plan for Tuesday's open, and there is one specific technical tripwire everyone needs to watch.
The line in the sand.
S&P 500, 6,808.
Which is exactly where we closed today. We're teetering right on the edge.
Because of the gamma wall sitting at 6,800.
Right. And for those tracking dealer positioning, the options math here is critical. Dealers are heavily long gamma right at that 6,800 strike.
Meaning, if the market stays above 6,800 tomorrow, they have to buy stocks into strength to stay neutral. It acts like a magnet, pulling us up toward 6,900.
A great built-in tailwind for the bulls, but the danger is what happens if we break below 6,800.
The polarity flips completely.
The trapdoor opens. Dealers suddenly have the wrong exposure. And to hedge their delta, they are forced to short S&P futures aggressively.
A delta hedging cascade. Every options dealer shorting the market at the exact same time just to balance their books.
And if that cascade triggers, the briefs identify the next major structural support as the put wall all the way down at 6,600.
That's a 200-point air pocket just sitting there if 6,800 fails.
And you have to monitor the bond market alongside that. The 10-year Treasury yield is the ultimate arbiter here.
The notes explicitly warn that if the 10-year yield breaks above 4.5% while the breath is this hollow, the setup becomes totally toxic.
High yields choke off the oxygen to those mega-cap tech valuations. If their cost of capital spikes, the lifeboat breaks.
Now, despite all this defensive positioning, there is always a bull market somewhere.
Sure.
We did have two massive momentum exceptions today that completely ignored the macro panic.
The anomalies. This is where the aggressive risk on capital is still playing.
First one is Sable Offshore Corp, ticker SOC, up 37% today on massive volume, 2.4 times relative volume.
A pure play on the geopolitical volatility we just talked about.
Exactly. When oil hit 120 on the Strait of Hormuz headlines, speculative capital flooded directly into SOC. And because it closed near the highs on that crazy volume, the strategy desks are flagging it as a primary day two play tomorrow.
A total headline-driven momentum setup, completely divorced from the CPI anxiety.
The second exception was Hims & Hers Health, ticker HIMS, up 36% today.
Incredible strength.
And unlike Sable, this had absolutely nothing to do with oil or the Middle East.
It's an idiosyncratic growth story.
Right. It broke out on its own fundamentals. It's not sensitive to a tick up in the 10-year yield or crude prices.
When you see a stock gap up 36% while the broader market has a 1-to-2 advanced decline ratio, that is glaring, targeted institutional accumulation.
Someone with very deep pockets is buying that specific story, completely ignoring the macro bloodbath underneath the index.
And that's the core takeaway for tomorrow's open. You cannot blindly buy the index right now. The market is actively faking it.
You've got three choices: hide in utilities and healthcare, raise cash and wait for the CPI dust to settle Wednesday, or hunt for isolated day two momentum plays like SOC.
It's a wait-and-see tape burdened by a very dangerous undertow if 6,800 snaps.
So as you review your own portfolio tonight, we want to leave you with one final thought. We established that the entire stability of the S&P 500 right now is relying on the mega cap 6 tech giants acting as a lifeboat.
Everyone is crowded onto one raft, while the small and mid-caps sink.
But what happens to this highly fragile market structure if a sudden macro shock, a hot CPI print, or the 10-year breaking 4.5% causes those last six giants to spring a leak?
If the safe havens become the source of the risk, the rotation will be violently unpredictable.
Exactly. If the lifeboat starts taking on water, where does the capital go next? That's a real question heading into tomorrow's open. Keep your eyes on that 6,800 level, watch the volume confirmation, and respect the closing print. Catch you after tomorrow's bell.